The story begins in the Roaring Twenties. The world felt alive. People believed the good times would never end. Money flowed fast. Stock prices rose like balloons. Borrowing to buy stocks became normal. Banks lent easily. They loaned to almost anyone. They treated money as candy. This easy credit fed a bubble. Speculation grew. Margin buying soared. Investors paid just 10% of a stock's price and borrowed the rest. By 1929, that margin debt may have reached 20% of market value on the New York Stock Exchange. This level of leverage set the stage for disaster. When prices moved down, margin calls forced mass selling. That intensified the crash. The first tremor came on October 24, 1929. It became known as Black Thursday. Fear replaced confidence. Panic selling began. Banks and large investors tried to calm the market. The bounce was brief. Just days later came Black Tuesday, October 29th. The market collapsed completely. Millions of shares flooded the market. Prices plunged. People lost huge sums overnight. Their borrowed money vanished. Brokers called in margin loans. Investors could not pay. Banks were drawn into a spiral. Debtors defaulted. Depositors panicked. They rushed to withdraw savings. Banks began to fail. Many closed permanently. Savings disappeared. By early 1933, around 9,000 banks had failed. Depositors lost frozen funds worth about $7 billion. These events starved the economy of money. Economic activity crashed. Factories shut. Businesses collapsed. The unemployment rate hit 25%. 1 in 4 workers had no job. Soup lines formed. People waited in long queues for free food. Many families lost their homes. They built shanty towns called Hoovervilles. Despair became widespread. The financial collapse became a debt deflation nightmare. Prices fell as debt stayed fixed. Irving Fisher described a vicious cycle. Debt liquidation triggered distress selling. The money supply contracted. Asset prices dropped. Business net worth shrank. Profits fell. Output shrank. Confidence evaporated. People hoarded cash. Interest rates adjusted upward in real terms. Debt burdens grew heavier as income shrank. This spiral deepened the crisis. Mainstream economic historians like Friedman and Schwartz argued that bank failures and a contracting money supply made things worse. They blamed the Federal Reserve for failing to act as lender of last resort. Because money vanished, spending collapsed. That caused GDP to drop sharply. Monetary policy mistakes turned a recession into the Great Depression. Research on credit booms shows that unchecked credit expansion can lead to bubbles. When the boom ends, debt burdens remain. Bad loans multiply, financial institutions weaken. The result is a crash. The 1920s credit boom fits this pattern. The crash left behind shaky investment projects and fragile banks. Real damage followed. What lessons emerged from this painful decade? First, do not rely on margin. Borrowing to invest may fuel gains, but it also magnifies losses. The crash made that clear. Second, banks need rules. The FDIC was created in 1933. It insured deposits. This changed everything. People no longer had to flee at the first hint of trouble. Regulation gained new meaning. Diversification matters too. Putting all eggs into one asset is dangerous. Banks that were less diversified were hit harder. Banks that served only local farms or industry collapsed when those sectors fell. Diversified banks survived better. They could keep lending, even in bad times. Government intervention became vital. Roosevelt's New Deal created programs to boost jobs and confidence, but recovery was slow. It did not really take hold until World War II. That massive shift to wartime production finally lifted the economy completely. In sum, the Great Depression taught harsh lessons. Bubbles fueled by loose credit will burst. Leverage can destroy wealth in hours. Banks need strong rules. Deposit insurance reduces panics. Diversification strengthens the system. Governments must be ready to act when crisis hits. And history shows innovation does not prevent disaster if safeguards fail. The story begins in Holland in the early 1600s. The country felt new and rich. It grew richer through trade. Ships brought spices and goods from the east. People had more money. They wanted fine things. Tulips arrived from Turkey. They had strange patterns. They looked alive. They felt rare. People loved them. Rich merchants and artisans paid anything for rare bulbs. They bought bulbs to show off. Tulip bulbs became status symbols. They traded bulbs instead of gold. They did so in winter. They traded bulbs that had not sprouted yet. Forward contracts appeared. Traders made deals on promise alone. They paid a fee for the promise. No bulbs actually changed hands. This trade took place in taverns. Easy money flowed. Prices kept climbing. By late 1636, rare bulbs sold for 10 times a craftsman's yearly income. In some cases, more than a nice house in Amsterdam. This came from contract prices, not actual cash trades. It was a speculative premium. Markets fueled themselves. The rising price made people join. They hoped to sell at a higher price. This is the classic bubble pattern. The crowd draws in more crowd. One word in peer-reviewed research calls it positive feedback or herding behavior. No price corrections came until no one else wanted to pay more. This pattern of excitement, greed, and then panic has repeated over time. The peak came in winter 1636 and early 1637. By mid-November 1636, planting was done. All bulbs lay underground, hidden. This caused the so-called sequestered capital. No one could see how many bulbs grew. No one knew the future supply. Speculators guessed future worth. Prices rose as if supply would stay scarce forever. Then came February 1637. Sprouts appeared above ground. That revealed large supply. Prices collapsed in the first week of February. The crash started in Haarlem. It spread quickly. Town by town traders suddenly found no buyers. Contracts stood, but no one paid. Some courts allowed late buyers to cancel contracts by paying a small fee. Others canceled all contracts. Most deals were voided. The tulip market froze. Many investors were stunned. They held contracts worth nothing. This disaster shocked people. Pamphlets and satirical songs mocked speculators. They warned against greed. This moment shaped the term tulip mania. Writers recorded the folly. The idea of one bulb costing more than a house seemed absurd. With regret, people shared the story as a moral lesson. Yet later, historians found that most stories were exaggerated. Only a small group took part. Many were wealthy merchants or skilled artisans. They were not poor farmers. They bet on a few rare bulbs. They lost money. But broad economic damage did not follow. The Dutch economy stayed strong. Trade continued. Real estate prices did not crash. Banks did not collapse. Only one case of bankruptcy linked to tulips is documented, and that person also had losses in real estate. Modern research by Anne Golgar shows that fear and gossip spread the tale more than facts. She traced contracts. She found fewer than half a dozen ruined by tulips alone. Market effects were local. Reputation damage happened more than financial ruin. In short, the fallout was real but limited. Economists such as Earl Thompson and Peter Garber revisited the data. They argued that rising tulip prices fit a pattern of rational expectations. People anticipated scarcity of rare bulbs. They also expected to resell contracts. When supply signals emerged, they corrected rapidly. They viewed the events not as madness, but as part of how markets respond to uncertain supply and delay. Still, this event became a powerful parable. It showed how popularity can feed on itself. It showed how speculation can detach from real value. It showed how crowd emotion drives bubbles. It helped shape later thought on finance. Nobel laureate Robert Shiller and others used it to show how investor psychology matters. What lessons do we learn from this soft flower craze that cost more than houses? First, it reminds us that just because something is popular does not mean it is worth so much. Demand can push prices far above real value. The rarest bulbs lost value once more appeared. Popularity is fragile. Second, it shows that when everyone is buying, caution is wise. The group sees only rising prices. People fear missing out. They join late, they lose most. Late traders paid much more than early ones. Price in the frenzy mattered more than any use. Third real value comes from utility. A tulip does not feed or shelter you. It is pretty. It is symbolic. But it has no ongoing cash flow like a farm or a rental property does. When the dream ends, so does the value. Fourth, it reveals mass hysteria's power. Ordinary people did things they later called foolish. They mortgaged houses or fields for bulbs. They bet on future promises. They believed rarity itself had value. Fear of missing out overwhelmed common sense. Finally, every bubble shares the same pattern. There is a rise fueled by excitement. Then more greed joins in. Then panic and crash follow. After the crash, people learn. They say never again. Yet history shows we forget. Tulip Mania is the classic example of that cycle. This episode is soft and strange. A flower caused it. Yet the pattern echoes in later crises. Dot-com stocks, housing markets, cryptocurrencies all follow similar arcs. Tulip Mania still teaches today. It warns us that fads are fragile. Markets driven by emotion end badly. What matters is actual value, not hype. In the end, even if most of Dutch society was untouched, the mania shaped how we see bubbles forever. It became a symbol, a warning, a soft tale of greed and regret. It reminds us to look past trends, to ask what we are really buying, to keep our senses, to watch for sprouts before price climbs, and to remember that even the prettiest flower can turn worthless when the crowd moves on. America stood tall after World War I. The nation felt unstoppable. New inventions like cars, radios, and refrigerators reshaped daily life. People felt excited and confident. The stock market turned into a giant casino. Ordinary men and women believed they could win big. Even shoeshine boys offered stock tips to their customers. The scene felt magical, finger on the pulse of modern life. Yet beneath the shine lay risk. Stock prices soared far above company earnings. Estimates show that price-earnings ratios reached over 30 by September 1929. That was high compared to the average of 15 or so. Some economists like Harold Bierman later argued that prices were not obviously absurd, but others saw grim signs of speculation. People borrowed heavily to buy more shares. Margin buying grew. Small upfront investments became risk magnifiers. When prices moved lower, margin calls forced selling. That added pressure to already inflated prices. On October 24, 1929, fear and doubt entered. Panic selling began. That day is remembered as Black Thursday. Big investors tried to stop the slide. A small bounce came, but the mood had shifted. Then came Black Monday on October 28th. The next day, Black Tuesday. Millions of shares changed hands. On Tuesday alone, around 16 million shares flooded the market. Prices collapsed in hours. The Dow Jones lost 89% of its value over the next 3 years as the crash metastasized. The market crash triggered a broader crisis. Banks failed. Borrowers defaulted. Depositors panicked. They rushed to withdraw savings. Thousands of banks closed. Money vanished from the system. The weather turned bleak. Production slowed. Factories halted. Businesses closed. Unemployment soared. By 1932, more than 13 million people were jobless. The ripple spread globally. Trade shrank. Confidence evaporated. This was the early heart of the Great Depression. Economists Milton Friedman and Anna Schwartz later studied the crash and its aftermath in their book, A Monetary History of the United States. They argued that the Federal Reserve missed its moment. It could have acted to stabilize banks and support the money supply. Instead, it allowed bank runs to happen and the money stock to shrink. This turned a recession into a full depression. Their work led to the idea of the Great Contraction. It spanned 1929 to 1933. Prices and production fell. The money supply dropped. Real interest rates rose even as nominal rates fell. Businesses and families felt the squeeze. Modern studies confirmed their view, that if the Fed had acted more forcefully, the downturn might have been less severe. Researchers using economic models showed that a looser monetary policy could have reduced the depth of the slump. Some scholars sought a deeper explanation for why prices soared before the crash. Eugene White and others suggest that rapid earnings growth in the mid-1920s gave investors hope. They believed profits would keep growing. High PE ratios may have reflected these expectations rather than pure mania. Irving Fisher, the famous economist, publicly stated just before the crash that stock prices were fair by fundamentals. He believed the era's scientific methods and management advances justified optimism. He turned tragically wrong when markets collapsed. Still, the crash teaches hard truths. Above all, that stock prices should reflect company profits. When markets deviate too far from earnings, risk grows. Borrowing to invest may boost returns, but it can also destroy wealth. When debt is high, small shocks become crises. Markets can stay irrational longer than most can stay solvent. Panic selling amplifies drops. When fear grips everyone, even careful investors lose. Professional investors are not immune. Many experts underestimated the crash and lost fortunes. The crash showed that bubbles often start as growth stories, but they become dangerous when expectations become detached from reality. Eventually, the dream collapses. The higher the climb, the harder the fall. From the crash emerged critical insights. Regulatory reforms followed. Market rules changed. Margin requirements rose. Bank supervision increased. The shock demonstrated that unchecked enthusiasm can lead to ruin. In soft terms, the story is a cautionary tale, a time when a confident nation forgot caution, where optimism blinded judgment, and where everyday people suffered when markets turned. It reminds us that market emotion can mislead, that borrowing amplifies both gains and pain, and that short-term euphoria can mask long-term weakness. Its legacy shapes market thinking nearly a century later. It underlines the need for connection between price and profit, for sane debt levels and calm when others panic. The crash marks the day the party ended. It shows that excess seldom sustains, and that true value matters more than hype. America once relied on savings and loan banks. They were quiet places. They held small savings. They lent to families for homes. Rules kept them safe. Home ownership felt steady and secure. Then the rules changed. In the 1980s, politicians removed many safety limits. S&L banks gained freedoms. They could offer higher interest. They could invest in commercial real estate. They could issue credit cards like big banks. Regulators hoped growth would solve earlier losses. At first, the world cheered. Thrift industry grew fast. Its assets rose sharply. Investors and depositors flocked. Many S&Ls paid high interest to attract funds. They did so by using federally insured deposits. No strong guardrails remained. Some owners used depositor money for their own gain. They treated the bank as a personal piggy bank. Fraud and insider abuse grew in hidden ways. High interest attracted money, but costs rose too. The banks kept long-term fixed mortgages. Meanwhile, interest rates rose. They had to pay more for deposits. But they earned little on old loans. Losses piled up. By 1983, many thrifts were insolvent. Regulators tried to ignore the losses. They let zombie thrifts stay open. Many banks survived only on forbearance. Risk hardened. Many S&Ls poured into speculative real estate or junk bonds. The Garn-St. Germain Act in 1982 allowed this new risk. The industry ran fast ahead, but it was built on bad loans. Capital cushions were weak, profit margins thin. Losses hid until markets turned bad, then value evaporated. Between 1986 and 1995, more than 1,000 S&L banks failed. Nearly 800 closed by regulators. The Resolution Trust Corporation handled their assets. Taxpayers footed the bill. Ultimately, the cost reached about $124 billion in direct losses. Some estimates push the total above $150 billion. Counted as part of national debt and recession costs, the damage was deep. Life savings, still insured, vanished in places. Many depositors lost trust. The FSLIC insurance fund collapsed. It lacked enough capital to pay out losses. That triggered stronger bailouts funded by taxpayers. Many voices cried foul. The outrage grew. Congress acted in 1989. It passed the Financial Institutions Reform, Recovery and Enforcement Act. That law abolished FSLIC and created new oversight. The Office of Thrift Supervision took charge of thrifts. The Resolution Trust Corporation closed failing institutions. New rules limited high-risk loans. Deposit insurance moved under the FDIC. The crisis taught harsh truths. First, that removing safety rules without care invites disaster. Deregulation fueled risk without matching control. Second, that high promised returns hide danger. When banks offered wildly attractive rates to depositors, one should worry. Third, moral hazard became real. When people believe their money is guaranteed, they may take bigger risks with it. S&L owners clearly did. Many made poor bets protected by taxpayers. Fourth, government insurance can fail its purpose if oversight is weak. Insurance means trust, but only if backed by rules and capital. Fifth, banking should be steady and simple. Growth or excitement in banking often precedes trouble. Owners sought profits in real estate development and junk bonds, but those bets clashed with their public role. This contradiction caused collapse. The crisis became a case study in moral hazard and insider fraud. The infamous Keating 5 scandal involved Lincoln Savings. Its owner had used political influence and depositor funds to invest poorly. When the scheme fell apart, scandal followed. Creditors, regulators, and politicians faced fallout. Later academic work explored deeper causes. Scholars looked at incentives inside the thrift industry. They showed how regulators deviated from optimal actions. They allowed weak banks to stay open. That worsened losses. Had timely intervention occurred, costs may have stayed smaller. A latent moral hazard feature grew without accountability. Lessons emerged. Regulation must fit risk. Rule change needs guardrails. Deposit insurance must come with strong enforcement. Moral hazard must be contained. Incentives must align depositors, managers, and taxpayers. Fraud must be rooted out early. This crisis left an industry forever changed. Thousands lost jobs, many lost money, but reforms followed. Oversight increased, capital rules tightened, deposit insurance became more robust. The industry moved towards stability. In soft narrative, the story is a caution, a time when a safe institution became dangerous, when removal of old limits released hidden dangers, when many banks chased risky profit, when people paid a heavy price. It reminds us that safety is not guaranteed by law alone. It needs clear limits, it needs oversight, it needs careful guardrails. Otherwise, safe can become unsafe. From this tragedy we learned that high interest often hides hidden risk, that promise of greater gain may hide deeper loss, that if you let banking become exciting, you invite instability, that government support must come with strict rules, that moral hazard can derail even well-meant policy. In the end, the tale of the S&L crisis is a softness turned sharp, a slow unraveling of trust, a lesson in how safety nets without structure can tangle and break, and how, when banking stops being boring, trouble often follows. America in the 1980s felt strong. The stock market had been climbing for years. People watched prices rise, confidence soared. Computers and new programs joined the trading world. Program trading let machines buy and sell stocks automatically. Many computers were set to act in the same way when prices changed. Investors felt bold but cautious trust lay in these systems. The stock market had seemed safe for a long time. Then everything changed. On October 19, 1987, panic swept the markets. The Dow Jones fell by 22.6%. It was the largest single-day drop in history. Global markets followed the crash. Losses worldwide totaled over $1 trillion in value. People watched in shock as prices plunged within hours. Many feared another Great Depression was starting. The damage was swift and deep. The speed surprised everyone. At the heart of the crash lay automated selling. Many computers followed portfolio insurance rules. These rules told a computer to sell as losses grew. The more they sold, the lower prices fell. That triggered more selling. The machines fed each other in a feedback loop. Each trade triggered another trade. It was like an avalanche of orders. There was no time to stop. Human emotion did not slow the machine. Analysts later showed that program trading accounted for about 10% of trades that day. However, the cascading effect made it far worse. This was confirmed by market inquiry reports and working papers of experts who studied circuit behavior and cascade theories. Another key force was index arbitrage. Traders tried to benefit when index futures and stocks diverged. That added more automatic trades. These strategies pushed prices lower even faster. Regulators and reports later blamed the mix of program trading, portfolio insurance, and index arbitrage for amplifying the crash, though they also stressed panic and liquidity drying up. Technology strained too. Trading systems struggled. Computers could not handle the surge. Orders piled up. Communication systems jammed, markets froze, some trading halted altogether. Market makers delayed or suspended trading as the imbalance overwhelmed them. The chaos added to fear. Many investors panicked, not because of news, but because of price motion itself. Behavioral studies showed participants reacting to price moves more than underlying fundamentals. When prices fell, margin calls came. Fund managers and brokers needed cash. They sold more. Liquidity vanished. Market function broke down. Confidence collapsed in hours. The Federal Reserve stepped in. It offered liquidity and support. Officials made a public statement the next day. They said they stood ready to lend. That helped. Markets began to recover within days. By November, many prices had rebounded. Fed actions were seen as timely and stabilizing. After the crash, regulators acted. They created circuit breakers. These allowed the market to pause during sharp declines. These breaking points give time to breathe and assess. They slow down panic selling. They are a legacy of Black Monday. Circuit breakers help markets avoid freefall in the future. This day taught powerful lessons. Computers can speed up crashes. When many use the same automated strategy alike, it can backfire. A shared sell signal can drive a spiral. Circuit breakers are now essential. Technology can solve problems, but it brings new ones too. Despite computers trading, human emotion still drives the market's rhythm. Researchers later studied market dynamics with models similar to systems in physics. They found critical points and aftershocks in price series around crisis days. Markets behave like coupled systems. Global indices moved together more than before. Correlations soared as markets jammed in sync. Black Monday became known as a global event. Markets crashed first in Asia, then Europe, and finally America. 19 out of 23 major industrial markets fell by more than 20%. Hong Kong lost nearly 46%. The shock crossed borders. The scale alarmed policymakers worldwide. Within months, stocks regained much lost value. By late 1987, many indices had recovered a good portion of their drop. Yet the crash marked a new era. It shaped market design. It changed surveillance. It reminded regulators that growth in technology must be balanced with safeguards. In a soft narrative, Black Monday feels like a modern storm. It started with confidence. It rose with technology. But then malfunction, panic, and speed converged. A day when machines did not ask, "Should I sell?" and millions watched losses without time to react. A day when trust evaporated in microseconds. What Black Monday taught remains relevant. Price moves can outpace reason. Automated strategies can amplify vulnerability. Crowds networked through machines may move in unison, win or lose. Circuit breakers help, but vigilance matters. Human oversight is essential. Emotion can amplify, and machines can obey without judgment. These truths echo in every flash crash and digital trade era. This story is a caution, a time when excitement turned fragile, a lesson that technology does not erase human errors, that safety needs rules, that speed without pause can destroy trust, that markets work best when they work slowly enough to let people understand. Black Monday marks the day the machines took over, but it also marks the day we learn to pause. It reminds us that no machine should outpace our common sense. The story began in fast-growing Asia. Countries like Thailand, South Korea, and Indonesia were rising. They earned praise as the Asian tigers. Capital flowed in from abroad. Local currencies were tied to the US dollar. This kept them stable. Many believed growth would never stop. The mood felt unstoppable. Then came trouble. Thailand had borrowed heavily in dollars. Foreign debt weighed on banks and firms. Speculators began testing the currency peg in May. The government fought back with its foreign reserves, but reserves fell fast. The currency stood on shaky ground. Then came early July 1997. Thailand let the baht float. It dropped quickly by about 20%. The peg collapsed. Confidence evaporated. That marked the start of regional chaos. Other Asian countries followed. Malaysia, Indonesia, the Philippines, and South Korea all saw their currencies crash. Markets pulled back investment. Capital flows reversed. Stocks and property prices sank. Economic activity slowed sharply. In countries worst hit, industrial production fell by double digits. Economies feared they had entered full recession. Millions lost their jobs. Families lost life savings. Banks teetered or collapsed. Many local banks had poor accounting and bad loans. They could not manage foreign debt when their currency fell. Markets punished even fundamentally solid economies. Panic spread like wildfire. Contagion jumped borders. Good countries suffered as much as weak ones. International help arrived. The IMF and World Bank provided bailout loans. Thailand received over $17 billion. South Korea and others also received support. Conditions came with that help. Countries had to cut government spending, raise interest rates, reform banks, and open markets. These changes reshaped politics and societies. In Thailand, governments changed. Reforms followed through. Slowly, recovery began. Some countries regained pre-crisis income levels within a few years. Malaysia rebounded first by 1999. Indonesia and Thailand took longer until around 2003 or more. Countries rebuilt economic stability. Many took lessons to heart. What stands out is risk in borrowing in foreign currencies. Growth built on foreign money can vanish fast when the local currency moves. Peanuts borrowed in foreign currency lead to heavy burdens once the exchange rate shifts. Fixed exchange rates can seem stable until they fail. After the peg broke, currencies fell by half or more. The Thai baht went from 25 to over 50 per dollar. The South Korean won and Indonesian rupiah also collapsed in value. This showed that when investors panic, they punish good and bad countries alike. Even strong economies suffered because trust vanished. Global markets are deeply linked. Shock in one place spreads everywhere. The crisis spilled into Russia and Brazil too. It became clear that countries need emergency reserves. They must be ready for sudden capital flight. Having deep foreign currency reserves, strict bank oversight, and careful regulation can limit damage next time. Later analysts studied the crisis. Some pointed to structural vulnerabilities like high short-term debt, weak banking rules, and rapid deregulation. They showed that these caused the crisis to unfold severely. Others emphasized the role of panic and herd behavior. Uncertainty and loss of trust made crises spread beyond reasoning. That contagion effect was powerful. Economists like Paul Krugman suggested that capital controls, temporary limits on money flows, can help in crisis times. Malaysia used such measures and recovered faster than many. Others opposed it. Still, the lesson remains. Sometimes tight control helps when markets run rough. The crisis also became a lesson in global financial architecture. Institutions like the IMF and ADB considered new ways to handle debt and liquidity shocks. Some proposed regional funds to stand ready for crises. In soft narrative, this crisis feels like a roar turned into silence, a period of confidence built on borrowed strength, a sudden fall when the safety line broke. Matrix of rules turned fragile. Markets moved faster than policymakers. It taught that real growth must come from value, not cheap capital. That debt must be sustainable. That fixing currencies locks risk until it doesn't. That when capital flees, even sound economies wobble. That markets are connected in ways small countries cannot escape. This story remains a warning. Future crises may wear different faces. Currencies or crypto, real estate or tech. But the cycle remains. Boom, optimism, debt, panic, crash. The crisis shaped policy for decades after. It sharpened focus on strong banking laws, more reserves, better debt transparency, and careful financial liberalization. It reminded the world that excitement can be dangerous, that governments need plans, that global linkages demand global readiness. In the end, the Asian tigers lost their roar. A tale of growth built on unstable footing, a lesson in the fragility of confidence. But also a tale of recovery and learning. It showed what checks are needed. It warned that fast money can be fragile, and that human consequence is real when economies fall. In the mid-1990s, the internet felt like magic. A new world opened. Companies with .com in their name seemed to promise the future. Investors rushed in. They poured money into firms without profits. Old business rules felt obsolete. Venture funding spilled everywhere. Stock prices rose fast. Tech shares soared 10 times or more. The Nasdaq index almost quadrupled. Many believed growth would never stop. Companies spent big on ads. Super Bowl spots flashed their logos. But many lacked any plan to make money. They chased clicks, not profits. They raised billions. They burned through cash. Earnings were weak or missing, yet stock prices kept climbing. The belief was that profits could come later. At its peak in March 2000, the Nasdaq index hit over 5,000. Then came a sharp slide. By October 2002, the index had lost nearly 80% of its value. Gains wiped away. Trillions of dollars vanished. Many dot-com companies folded overnight. Pets.com, Webvan, Boo.com, they disappeared. Even established firms lost massive value. Cisco and Amazon fell dramatically. Lives and retirement funds suffered. The broader economy dipped into recession. Unemployment edged up. Confidence cracked. Researchers later studied the bubble in detail. One study analyzed 30 firms during that era. It found that sales, net profit, and even debt were driving stock prices. Asset size had little effect. Investors focused on growth signals, not steady fundamentals. That study showed how speculative behavior outpaced real performance. Another study dissected Nasdaq stocks using advanced models to detect bubble dynamics. The bubble consisted of overlapping waves of exuberance. There were indeed multiple starting points for the fever in tech stock prices. Investors believed in a new economy. Many hoped for fast gains, ignoring fundamentals. The bubble followed 5 typical stages described by economists. It began when a new trend captured attention. Then boom followed. Euphoria took hold. Later profit-taking began. Panic ended the cycle. Prices collapsed in a rush. One key lesson stands out. New technology excites the crowd, but excitement must lead to value. Many dot-com firms never made money, yet they attracted hypervaluations. That disconnect proved dangerous. The phrase, "this time is different," became a warning sign. The bubble also showed how easy money and venture capital can fuel danger. Funding flowed freely. Young companies raised capital without proof of earnings. Investors traded hype, not value. The less companies earned, the louder the promises. Even great innovation takes time to prove itself. The internet was revolutionary, but real value came later, from Amazon's eventual profits or eBay's marketplace. Many early dot-coms lacked product or revenue plans. This bubble also taught us that popular beliefs can distort rational investment. Herd behavior dominated. People clung to rising charts. They believed stocks would never fall. That psychology pushed prices far past value. Yet even smart investors missed the signs. Some funds and banks bought into the craze. Plenty of fund managers lost. The idea that professional investors always know more was shaken. From this crash, we also learned about diversification. Those who held a mix of tech and non-tech stocks recovered faster. Balanced portfolios fared better in the rebound. Investors focused solely on tech suffered most. The period also influenced future regulation. It ushered in stronger disclosure rules and more scrutiny of IPOs. Venture funding practices came under criticism. Some firms had inside trading or over-optimistic estimates. Regulators later tightened oversight. In soft narrative, this era feels like a dream that ran wild, a party fueled by illusions, a dance on speculative clouds, then a fall when gravity returned, a time when belief outpaced earnings, and when digital excitement eclipsed caution. Still, the internet continued to grow. It reshaped our lives. But the bubble reminded us of value, that profits matter, that novelty alone does not justify high prices. Today, the dot-com bubble endures as a classic story. It illustrates how human emotion and speculation can distort markets. That fast growth without earnings leads to sudden collapse. It taught caution about chasing the next big thing without a solid foundation. We learned that excitement must meet reality, that high expectations without delivery fall apart, that investment must be rooted in fundamentals, and that bubbles follow familiar arcs: boom, euphoria, crash, and lessons learned. In sum, the dot-com bubble taught us time and again, new tech is thrilling. But companies must earn, not just promise. The future unfolds slowly. Even good innovation needs patience, and markets work best when backed by profit, not hype. That is the soft yet sharp memory of when websites were worth billions. Banks once believed everyone deserved a home. They lent to people without income, job, or assets. These were known as ninja loans. They trusted home values would only rise. Loans were packaged and sold as mortgage-backed securities around the world. Buyers included institutions and investors everywhere. That created a chain linking borrowers to global markets. Housing prices soared. Many assumed they would keep rising. Home ownership became proof of success. Boom turned fast. Demand led to building and speculation. Real estate values doubled between 2000 and 2006 in many areas. Some homes were bought as investments, not as places to live. This reckless optimism fed itself. But the bubble burst. By 2006, house prices flattened and then turned down. Borrowers with adjustable rate loans saw payments rise, foreclosures soared, defaults climbed, banks faced losses, securities backed by mortgages lost value quickly. Some were rated AAA but proved weak. Losses spread through the system as credit dried up. The collapse of Lehman Brothers in September 2008 marked a tipping point. The firm had large holdings in mortgage-linked assets. When it failed, panic rippled through markets. Investors saw that a major bank could fall. Markets froze. Liquidity vanished. Governments scrambled to respond. They injected dollars, guaranteed deposits, and rescued banks. The response ran into trillions. The crisis spread worldwide. Banks in Europe and Asia held similar toxic assets. Stock markets crashed. Jobs vanished. Unemployment rose globally. The world entered recession. This crisis lasted for years. It reshaped how people saw finance. Several peer-reviewed studies and the official Financial Crisis Inquiry Commission cited key causes. They identified failure in financial regulation, reckless risk-taking, and high leverage. They pointed to weak mortgage underwriting, complex securitization, and flawed credit ratings. Institutions misrepresented risk. That made failure systemic. Banks lent too easily. Mortgage standards fell. Borrowers got loans they could not repay. Mortgage originators passed them on. These loans got bundled into bonds. Rating agencies gave many of them high ratings despite poor quality. Investors trusted the ratings. They bought trillions in toxic assets. When defaults rose, those bonds fell in value. Banks and investors lost huge sums. Shadow banking entities were exposed. Many had borrowed short-term to invest long-term. Leverage ratios of 40-to-1 meant a small drop erased capital. The system was brittle. Banks did not hold risk. They shared it. But risk was hidden in complex derivatives and off-balance sheet vehicles. Transparency vanished. When the market turned, everyone withdrew. Confidence collapsed. The crisis also exposed moral hazard and incentive misalignments. Executives earned big bonuses based on deal volume, not risk. They repackaged and sold risky products. They had little accountability. Taxpayers ultimately paid. The Dodd-Frank Act and stronger capital rules followed. What did this teach us? First, reckless lending burdens everyone. Second, complex products hide danger until too late. Third, housing bubbles can be as damaging as stock bubbles. Fourth, too big to fail banks create moral hazard. Fifth, greedy incentives can make smart people do dumb things. Case studies show that borrowers with ninja loans defaulted at much higher rates. Mortgages made with no income or assets failed as soon as home prices dropped. That fueled foreclosures and systemic losses. Research shows that subprime mortgages began failing when teaser rates expired. Defaults rose sharply in 2007. That reduction in cash flow from housing spread to mortgage-backed securities broadly. Banks across the US and Europe held these assets and suffered losses. Eventually, major institutions failed or required bailout. Another study used network models to show how interconnected financial firms made the system fragile. A shock in one firm could cascade across many. The fall of Lehman Brothers demonstrated that fragility. The study showed how deregulation and the repeal of Glass-Steagall led to higher systemic risk. After the crisis, policymakers strengthened rules. Capital requirements rose. Banks faced stress tests. Regulators demanded greater disclosure. Institutions had to limit risky lending. Home loans with no verification were banned. Institutions had to balance leverage and risk. For individuals, the crisis taught caution too. It showed that home ownership is not always safe. Debt must be sustainable. Buying property without a long-term plan exposes people to ruin. Diversification matters. Relying only on real estate and debt can destroy household finances. Above all, it showed that when banks take huge risks, taxpayers often pay the price. Insurance or bailouts come with systemic cost. The crisis triggered moral hazard and highlighted the need to align incentives. In simple narrative, this is the story of a dream turned nightmare. A housing boom built on debt and belief crashed hard. Home value fell, loans defaulted, banks collapsed, global markets froze, millions lost jobs, homes, life savings. It taught that growth built on shaky foundations fails, that complexity can conceal risk until collapse, that big banks need special rules, that incentives shape behavior, that a system must be resilient, yet the world recovered, economies rebuilt. New rules came, lessons endured, but risk remains. The 2008 crisis reminds that greed and blind faith can topple systems that seem secure. In soft tone, this is a cautionary tale, a story of how housing hope became financial ruin, how cheap credit multiplied risk, how global markets echoed one failure, how complex products masked danger, how ultimately people paid when trust failed. This crisis reshaped finance, policy, and how we think about risk. The housing dream became a nightmare, and the lessons remain clear. Europe built a shared currency. It was called the euro. But each country kept its own budget. Countries like Greece, Spain, and Portugal borrowed cheaply. Investors believed in growth. Governments spent more than they earned year after year. People trusted that strong countries like Germany would help if trouble came. Then trouble came. Greece revealed it had lied about its debt levels. Borrowing had surged behind the scenes. Investors panicked. They demanded much higher interest to lend. That made new borrowing cripplingly expensive. Because of the euro, countries could not print their own money. They could not devalue their currency. They lost control of basic tools to ease crisis. Greece and others faced a harsh dilemma. Unemployment soared. In Greece, it reached roughly 27% at its peak. Among young people, it climbed to nearly 60%. Spain and Portugal saw similar pain. Vast numbers could not find work. Many lost hope. Real income collapsed. Health and welfare systems grew fragile, especially in Greece, where access to medical care dropped sharply among the poor. Governments responded with spending cuts and tax hikes. These austerity measures aimed to shrink deficits. But growth stalled. Cuts deepened the slump. Public services eroded. Poverty grew. Inequality widened. Infant mortality and suicide rates rose in some places. Greece entered multiple bailout programs from the IMF, ECB, and European Commission. The funds came with strict conditions: service cuts, privatization, wage restraint. These austerity programs deepened recession. GDP fell by about 35% relative to what it might have been without austerity. Lower income groups suffered most, losing up to half their income compared to fit forecasts. Political backlash followed. New elected governments rose on anti-austerity platforms. In 2015, Greece elected Syriza amid frustration with economic hardship and brain drain across youth generations. Similar movements gained strength in other countries too. This crisis threatened the unity of the euro. Countries debated debt restructuring, transfers, and joint fiscal support. Without a shared federal budget, Europe had no true crisis shield. Countries could not inflate away their debt, nor devalue currency, nor default without deep shocks to banks in other countries. The crisis spread far beyond Greece. Spain and Portugal entered bailout programs or near defaults. Ireland and Italy faced severe pressure on bonds. The contagion threatened the entire euro area. The euro's design constraints deepened the crisis. Yet lessons emerged. First, sharing a currency without a shared budget is risky. Without fiscal federation, crisis tools remain fragile. Second, government debt can be dangerous and countries can go bust, even advanced ones. Third, austerity and recession often worsens outcomes. Cuts reduce growth, deepen unemployment, and prolong decline. Fourth, political cooperation is harder when times are tough. Disagreement rises. Solidarity frays. In democracies, pressure mounts for change. Fifth, even well-run countries can make large errors under pressure. Greece's misreporting, weak institutions, and poor oversight magnified the crisis. Institutions also played a role. Countries with inclusive and transparent institutions resisted shocks better. In contrast, those with extractive or weak governance suffered worse unemployment and poverty outcomes. Unemployment rose sharply. Austerity measures cut government purchases and raised taxes. That lowered output and increased joblessness. Public wage cuts and investment reductions explained much of the pain. Recovery lagged. Unemployment remained high even after GDP regained some ground. The crisis reshaped policy in Europe. The ECB expanded monetary tools. Governments adopted stronger frameworks. Oversight rose for deficits and debt. Bailout designs shifted to limit moral hazard. but resilience gaps remained. In soft terms, the crisis feels like a roaring economy losing its voice. Confidence vanished. Countries that seemed stable cracked under debt. Markets turned cruel. Citizens struggled with austerity and loss. A dream of shared prosperity frayed without shared responsibility. Over nearly a decade, Greece endured deep recession. GDP shrinkage, jobless youth, immigrants, and broken public services defined daily life. Many lost savings and opportunities. Banks held non-performing loans for years. Recovery came slowly. Yet the crisis also brought change. Countries reformed labor markets. Greece gradually exited bailout regimes in 2018. Growth resumed, but inequalities remained stubborn. Many labs pointed to lingering effects of austerity on young people and healthcare. In essence, the European debt crisis taught lasting lessons. Sharing a currency without fiscal unity is fragile. High debt can cripple even stable countries. Deep cuts during downturns hurt growth and social cohesion. Cooperative political systems matter. And advanced democracies can still falter when economic shocks collide with institutional gaps. In narrative soft tone, this is a story of how strong economies lost faith in markets. A lesson in the risks behind cheap credit and fixed exchange regimes. A message that solidarity must be built in institutions, not assumed. A caution that borrowing endlessly and spending freely dances dangerously close to collapse. And yet, the crisis shows recovery is possible. Reforms, unity, and new thinking can rebuild trust. The euro survived. Growth returned. But memory remained, because this crisis asked hard questions. When countries cannot pay their bills, they need more than money. They need unity, resilience, and the humility to build systems that hold in crisis. In early 2020, a new virus began to spread. Countries locked down, businesses closed, people stayed home. This was the first time governments truly shut down parts of the economy by design. Global supply chains that had worked for decades suddenly broke down. Factories closed, ships docked, flights grounded. The world came to a standstill. The shock was sudden. Stock markets fell 30% in a few short weeks. That fall carried dread. Then recovery came quickly. Markets rebounded to record highs. But beneath the surface, things had changed forever. Millions of small businesses closed. Restaurants, shops, travel firms, salons, and more vanished. Jobs disappeared fast. Unemployment soared to levels not seen since the Great Depression. In the United States, millions lost work. By spring 2020, over 23 million jobs had disappeared. Unemployment rates shot above 14% by April. Those losses cut deeply into people's incomes and savings. Global income earned by workers fell about 10% in the first 9 months of 2020. That translated into a loss of over $3.5 trillion worldwide in earned income. Many families struggled to meet basic needs. These realities stem from global estimates of lost work and income during the crisis. Governments reacted fast. They printed trillions in new money. They provided grants, loans, and unemployment benefits. In the US, Congress passed massive stimulus bills. These steps helped cushion the worst. Studies showed income support and insurance helped reduce poverty and shorten recovery time. Without those policies, poverty could have ballooned. With stimulus, some households rebuilt faster, yet support came with consequences. Inflation rose sharply, supply chains remained strained, workers shifted from services to goods, demand met shortages, price spikes followed, energy, food, and shipping costs rose. These fed into rising inflation, which in 2021 reached rates not seen in some countries for nearly 40 years. Studies estimate that supply chain shocks accounted for 10 to 20% of inflation in major regions like the US, Euro area, UK, and Canada. These pressures were the dominant early driver of price rises, even more than tight labor markets. Lockdowns revealed deep fragility in global supply chains. Research showed that prolonged disruptions, such as closed ports or factory shutdowns, led directly to inflation pressures and production collapse across industries and countries. Unemployment hit the hardest in sectors like travel, hospitality, and retail. Those least educated and lowest paid suffered most. Temporary job loss was widespread, especially among youth and women. In nearly 70% of countries, temporary unemployment rose most for workers with only primary education. Recovery varied widely across groups. Financial markets recovered faster than the real economy. Investment rebounded. Consumers shifted to digital life. Remote work rose sharply. Technology companies grew stronger. Some jobs moved permanently home. Digital shopping and delivery surged. Even as physical businesses closed, some firms thrived in the shift. As economies reopened, inflation remained stubborn. Central banks raised interest rates. Many governments carried record-high debt. Global sovereign debt rose sharply, inflation peaked in 2022, and central banks tightened to slow it. The policy trade-off between supporting recovery and fighting inflation became painfully clear. By mid-2021, many economies had rebounded from the recession. Some mirrored a rapid U-shaped recovery. For example, New Zealand, after a deep 12% quarterly GDP drop in mid-2020, bounced back sharply to grow overall, ending the year with slight positive growth. But others recovered slowly. Output gaps remained. Many countries failed to regain their pre-pandemic trend before hitting fresh shocks. 5 years on, the crisis continues to leave marks. Debt remains elevated. Inflation lingers in some regions. Work patterns changed. Office vacancy rates remain high. Remote work is permanent for many. Travel habits shifted. The economy looked different in 2025 than in 2019. Scholars and economists have drawn powerful lessons from this crisis. First, the economy can shut down faster than anyone imagined. A viral outbreak allowed governments to halt growth by closing businesses and restricting movement. That shock cascaded through trade and jobs. Second, government spending can prevent a depression, but it can also spark inflation if demand outpaces supply. Third, technology firms gained power during lockdowns, but their growth also highlighted inequality and dependence on digital platforms. Fourth, supply chains need backup plans. Diversified sourcing and better planning could reduce future shocks. And fifth, work itself changed. Many jobs shifted online or remote. That transition is now permanently part of our economic landscape. The crisis also taught that health emergencies can become economic disasters very quickly. A virus can halt trade, wages, and opportunity. That connection between public health and financial health became crystal clear. Case studies illustrated these lessons. One study of the San Francisco Bay Area modeled income loss during a 3-month shelter-in-place. Without support, poverty would have soared. With stimulus and unemployment insurance, poverty rose far less, and recovery time fell from nearly a year to under 7 months. Another study showed how supply chain breaks in the UK food market caused price and availability disruptions, even though the chain proved resilient overall. In soft narrative, this moment reads like the earth stopped turning. Confidence froze. Workers stayed home, factories paused. But then money flooded, prices rose, and markets snapped back. Yet deep scars remained. Jobs lost, businesses gone, supply lines strained, trust shaken. Recovery came, but not without cost. Inflation and slowed growth haunted policy. Governments entered near-permanent deficits. Firms rethought resilience. Workers rethought work itself. Economies restructured. The story of COVID-19's economic crisis shows that a health shock can topple systems. That stimulus buys time but can fuel inflation. That digital transition rides unevenly across society. That supply chains need robust design. That the world economy is fragile but adaptable. And most of all, it shows that in the face of sudden stop, choices matter. Speedy support matters. Planning matters. Solidarity matters. Because when the world stops, recovery begins with how we act, what we protect, and how we rebuild. This chapter remains a story of how a global health crisis shut economies, exposed fragility, and reshaped work, finance, and life. It teaches that even in fear, we can choose to rebuild wisely,